Why earning more money doesn't necessarily make you wealthy. If you earn $10,000 a month, does that automatically make you wealthy? Most people would say yes. But what if I told you that someone earning $10,000 a month could be financially weaker than someone earning $2,000? Sounds strange, right? Here's the truth. Income and wealth are not the same thing. You can earn a lot of money and still have very little wealth. And you can earn a modest income while steadily becoming wealthier. So in this lesson, we're going to uncover the difference between income and wealth, why high income doesn't automatically make you rich, and, most importantly, how you can turn the money you earn into lasting wealth. Because making money is one thing, keeping it, growing it, and turning it into wealth is something completely different. Let's begin. Introduction. When you hear someone say, "He makes a lot of money," what immediately comes to your mind? Do you automatically think, "He must be wealthy"? Most people do. If someone earns $10,000 a month, we may assume that person is rich. If someone earns $20,000 a month, we may assume they are financially successful. But here is the question. Does a high income automatically make you wealthy? No. And understanding this difference is one of the most important foundations of financial literacy. Because income and wealth are not the same thing. You can have a high income and very little wealth. You can also have a moderate income and gradually build significant wealth. So today, we're going to break down one of the most important distinctions in personal finance. Income vs. wealth. We will answer several important questions. What exactly is income? What exactly is wealth? How are they different? Why can someone with a very high income still be financially weak? How can you turn income into wealth? And most importantly, what should you actually focus on if your goal is long-term financial freedom? Let's begin. Part 1. What is income? Let's start with the simplest concept. Income is the money or economic value you receive over a period of time. It can come from many different sources. For example, you work for a company and receive a salary. That's income. You run a business and generate money from it. That's income. You rent out a property and receive rent. That's income. You receive dividends from investments. That's income. You provide a service and get paid for it. That's income. So when we're talking about income, we're basically asking, how much money is coming in? For example, imagine Sarah earns $1,000 per month. Her monthly income is $1,000. Another person, David, earns $5,000 per month. His monthly income is $5,000. And another person, Michael, earns $15,000 per month. His monthly income is $15,000. If we're only comparing income, Michael earns the most. But we still don't know who is wealthier. Why? Because income tells us about money coming in. It doesn't tell us what the person owns, and that's where wealth comes in. Part 2. What is wealth? Wealth is a different concept. In personal finance, one useful way to measure wealth is through net worth. The basic formula is net worth equals assets liabilities. Let's break that down. Assets. Assets are things you own that have economic value. For example, cash, money in your bank account, a house, land, a business, stocks, bonds, other investments, and other valuable property or financial assets. Now let's look at the other side. Liabilities. Liabilities are financial obligations you owe. For example, a mortgage, a personal loan, credit card debt, business debt, or other financial obligations. So imagine you own assets worth $100,000, but you owe $40,000 in debt. Your net worth is $100,000 minus $40,000 equals $60,000. So your wealth, measured by net worth, is $60,000. This is why wealth is not simply, how much money do you make? It's much closer to, what do you own minus what you owe? Part 3. Income and wealth are different. Now let's put the two concepts together. Income is about earning. Wealth is about ownership and accumulation. Income is a flow. Wealth is more like a stock of accumulated economic value. Think about water. Imagine a pipe bringing water into a tank. The water flowing through the pipe is like income. The water accumulated in the tank is more like wealth. The flow and the accumulation are connected, but they are not the same thing. You can have a very strong flow but an almost empty tank. And you can have a moderate flow while gradually filling the tank over many years. That's exactly what can happen with money. Someone can earn $10,000 every month but spend almost all of it. Another person might earn $3,000 per month, spend $2,000, and consistently save and invest the remaining $1,000. Over time, the second person may build substantial wealth. So remember, high income does not automatically equal high wealth. Part 4. How can someone with a high income have little wealth? This is where things become interesting. Let's imagine two people. Person A earns $10,000 per month. Person B earns $3,000 per month. At first glance, you might think person A is financially better off. But let's look deeper. Person A spends $9,800 every month. He has expensive habits. He finances an expensive car. He lives in an expensive house. He constantly upgrades his lifestyle. He has significant debt. At the end of the month, almost nothing remains. Person B earns $3,000, but spends $2,000. The remaining $1,000 is consistently saved and invested. Over several years, Person B builds assets. Person A may have a much higher income, but Person B may have a stronger financial position. This teaches us something extremely important. What you earn matters, but what you do with what you earn matters too. Part 5. The Lifestyle Trap. One of the biggest reasons high-income people fail to build wealth is something called lifestyle inflation. Lifestyle inflation happens when your spending increases as your income increases. Imagine you earn $1,000 a month. You live within that income. Then you get a better job. Now you earn $2,000. Instead of keeping your lifestyle relatively stable, you immediately upgrade everything. A better phone, a better car, a more expensive house, more restaurants, more entertainment, more travel, more expensive clothes. Then your income increases to $4,000, and your lifestyle expands again. You now spend $3,800 or $4,000 every month. Then your income becomes $6,000. But your expenses become $5,800. You are earning more, but you're not necessarily becoming wealthier. This is the trap. Your income keeps increasing. Your lifestyle keeps increasing, but your wealth doesn't increase at the same rate, and sometimes it doesn't increase at all. That's why the goal shouldn't simply be, I want to earn more money. A better goal is, I want to increase my income while increasing my net worth. Those are two different goals. Part 6. Income is important. Now I want to make something very clear. This lesson is not saying, income doesn't matter. Income matters a lot. In fact, income can be one of the most powerful tools for building wealth. If you have no income, it becomes difficult to save. Without savings, it becomes difficult to invest. Without investable capital, building assets can become much harder. So income is important, but income is not the final destination. Think of income as a resource. The question is, what are you going to do with that resource? You can consume it, you can waste it, you can use it to pay unnecessary debt, or you can use part of it to build your financial future. This is where financial decision-making becomes important. Part 7. How income becomes wealth. Let's create a simple financial chain. It looks like this. Income right arrow, expenses right arrow, surplus right arrow, savings / investment right arrow, assets right arrow, wealth. Let's break it down. Step 1. Income, you earn money. For example, $2,000 per month. Step 2. Expenses, you spend money on your needs and wants. Let's say you spend $1,500. Step 3. Surplus, you have $2,000 income minus $1,500 expenses equals $500 surplus. That $500 is extremely important because now you have capital that can potentially be used to build your financial future. Step 4. Save or invest. Instead of spending the remaining $500, you save or invest it according to your financial situation and goals. Step 5. Build assets over time. Your savings and investments can help you acquire assets. Step 6. Build wealth. As your assets grow relative to your liabilities, your net worth can increase. So the process is not simply make money. It is make money, keep some, right arrow allocate it wisely, right arrow acquire assets, right arrow build wealth. That's a completely different way of thinking about money. Part 8. Consumption vs. wealth building. Here's another distinction I want you to understand. There is a difference between consuming money and using money to build wealth. Suppose you have $5,000. You could spend the entire $5,000 on things that provide immediate enjoyment. There is nothing inherently wrong with spending money. We all need to spend money. Food, housing, transportation, education, entertainment. These are all part of life. The problem comes when almost everything you earn is consumed and very little is used to build your financial foundation. Wealth building requires some level of delayed gratification. You give up some consumption today in order to increase your financial capacity tomorrow. That doesn't mean you should never enjoy your money. It means you should understand the difference between spending money and allocating money. Spending asks, what can I buy? Financial thinking asks, what is the best use of this money? That is a major shift in mindset. Part 9. Look beyond appearances. Another major financial mistake is judging wealth by appearances. You see someone driving a luxury car. You think, that person is rich. But you don't know whether the car is fully paid for. Maybe the person has a large car loan. You see someone living in a huge house. You think, they are wealthy. But you don't know how much debt is attached to that house. You see someone wearing expensive clothes. You think, they have money. But you don't know whether those clothes were purchased with debt. This is why appearances can be misleading. Consumption can look like wealth, but consumption and wealth are not the same thing. Someone can look wealthy while having a weak financial position. Someone else can look ordinary while quietly building substantial wealth. So don't measure wealth only by what you can see. Look at the underlying financial structure. Part 10. Assets, liabilities, and net worth. Let's return to our formula. Net worth equals assets, liabilities. Imagine you have $20,000 in savings, a business worth $30,000, investments worth $10,000, and a property worth $80,000. Your total assets are $140,000, but suppose you also have $30,000 in loans. Your net worth is $140,000. $30,000 equals $110,000. That's a much more meaningful measure of your financial position than simply saying, I own a house worth $80,000. Because the real question is, how much do you actually own after accounting for what you owe? This is why financially literate people pay attention to both sides of the balance sheet. Part 11. The two questions you should ask. From now on, whenever you hear someone say, I make $5,000 a month, don't immediately think, that person is wealthy. Instead, ask two different questions. Question 1. How much does this person earn? That's income. Question 2. How much does this person own after subtracting what they owe? That's net worth. These two questions give you very different information, and you should learn to keep them separate. Part 12. Which one should you focus on? So, should you focus on income or wealth? The answer is both, but understand their different roles. Income gives you financial fuel. Wealth represents accumulated financial resources. If your income is low, one of your priorities may be increasing your earning ability. Learn valuable skills, improve your education, build experience, create valuable services, start a business, look for better opportunities. But as your income increases, don't make the mistake of increasing your lifestyle at the same speed. Instead, Use part of your additional income to strengthen your financial position. Increase your savings. Reduce harmful debt. Build investments, acquire productive assets, and gradually increase your net worth. That is how income can become wealth. Part 13. The real goal. Let's imagine two people. Person A says, "My goal is to make $10,000 a month." Person B says, "My goal is to build a net worth of $500,000. These goals are not the same. Person A is focused primarily on income. Person B is focused on accumulated wealth. Of course, Person B still needs income or another way to build capital, but the difference is the final objective. If you only focus on income, you may become trapped in the cycle. Earn right arrow, spend right arrow, earn more right arrow, spend more. But if you focus on wealth building, the cycle becomes earn right arrow, spend intentionally right arrow, save. Invest right arrow, build assets right arrow, increase wealth. That second cycle is what we want to understand throughout this financial education journey. Part 14. A simple example. Let's make this extremely practical. Imagine you earn $2,000 per month. Your expenses are $1,600. You have $400 left. You now have a choice. You can spend that $400, or you can allocate some or all of it toward your financial goals. Let's say you consistently save and invest $400. That's $400 times 12 months equals $4,800 per year. Over several years, that can become meaningful capital. And if those funds are invested appropriately for your circumstances and generate returns, the growth can potentially compound over time. This is why wealth building is often not about one huge financial decision. It can be about consistent decisions repeated for years. Small financial actions can become significant when combined with time, discipline, and sound decision-making. Part 15. The most important lesson. So, what should you remember from today's lesson? Remember this: income is what you earn. Wealth is what you accumulate and own after accounting for what you owe. Income is not wealth. A paycheck is not wealth. A high salary is not automatically wealth. A luxury lifestyle is not automatically wealth. Wealth is built through the accumulation of valuable assets relative to liabilities. And income can be one of the tools that helps you build it. So don't only ask, how can I make more money? Also ask, what am I doing with the money I make? And eventually, is my net worth growing? Those questions can completely change the way you think about money. Let's summarize today's lesson. We began by asking, does earning more money automatically make you wealthy? The answer is no. We learned that income is the money or economic value you receive over time. Wealth, often measured through net worth, is assets minus liabilities. We learned that someone can have a very high income but little wealth if they spend everything they earn, accumulate excessive debt, or fail to build assets. We also learned that someone with a moderate income can gradually build wealth through disciplined saving, investing, and asset accumulation. Most importantly, we learned this financial chain: income right arrow, surplus right arrow, savings / investment right arrow, assets right arrow, wealth. So your financial goal shouldn't simply be to earn more. Your goal should be to develop the ability to earn, manage, save, invest, build assets, and ultimately build wealth. But now we have another important question. If income is the starting point of this process, then where does income actually come from? Is there only one type of income? Is salary the only way to earn money? What is the difference between active income and passive income? Which types of income require your time? Which types can potentially continue generating money without your direct involvement every hour? And how do different income sources affect your path toward financial freedom? Those are the questions we'll explore in our next lesson. Types of income. Active income versus passive income. This is Modern Financial Institute. No gurus, no hype. No shortcuts. Just financial knowledge, clear thinking, and practical education. I'll see you in the next lesson. Have a good day.